Okay, let's unpack this. Imagine your teenager, maybe even younger, makes thousands of dollars this year.
Mhm.
And it's not from, slinging lattes or coding apps. It's from their investments.
Right. Passive income.
Exactly. Maybe it's dividends on stock, grandma gifted them years ago, or interest from bonds, maybe even capital gains from selling some crypto they bought with saved allowance money.
Okay.
On the surface, this sounds fantastic, right? A kid with investments, learning about finance, building wealth early. What could possibly go wrong?
Well, here's where it gets really interesting. What could go wrong is Uncle Sam stepping in and saying, hold on a minute.
Yeah.
That type of income, unearned income, isn't going to be taxed at your child's typically very low tax rate. We're going to tax a significant portion of it at your rate, the parent's rate.
Oh.
And that rule, designed specifically to prevent tax avoidance, is known as the U.S. Kiddie Tax.
The Kiddie Tax. It's got a sort of innocent-sounding name, doesn't it? Almost like something from a kid's book about money.
It does sound deceptively simple, yeah.
Yeah. But from what we've seen in the sources, this is serious stuff. Real financial implications.
It absolutely is.
Yeah.
And it's one of those tax rules that's widely misunderstood, I think.
How so?
Many people hear kiddie tax, and they immediately picture only the wealthiest families, trying to shift millions around to dodge taxes.
Right. Like it's only for the 1%.
But the reality is, families of relatively modest means can run smack into this rule if a child has unearned income above a surprisingly low threshold.
Okay, so it's not just for the super rich.
Definitely not. It's for any family where a child has investment income that meets certain specific criteria we'll get into.
So our mission for this deep dive, then, is to really guide you through the intricacies of this U.S. Kiddie Tax. We've pulled together a stack of sources, official IRS instructions, insights from financial planning groups like Greenbush and Trust and Will, plus explainers from places like Saving for College and Wikipedia.
Good cross-section.
Yeah, we're going to try and translate the tax jargon, explain who this actually applies to, how it's calculated with the specific numbers for 2024 and 2025, why it even exists in the first place.
And crucially,
dive into some often overlooked, potentially far more significant pitfalls that come with putting assets in a child's name, things that go way beyond just the tax itself.
Absolutely. We're aiming to give you the essential nuggets of knowledge. The goal isn't to turn you into a tax preparer overnight,
Definitely not.
but to make you well-informed enough to understand when this rule might apply to your family. And, perhaps more importantly, to recognize the potential sort of downstream consequences of financial decisions involving kids' assets.
And why does this deep dive matter specifically to you, our listener?
Well,
Because understanding the Kiddie Tax and all these related implications can save you from unexpected tax bills. It could protect your family's eligibility for college financial aid and help you make smarter long-term financial decisions about saving and gifting for, the next generation.
overlooking these rules is easy. It really is. But the cost of that oversight can be pretty significant.
It's about being proactive rather than reactive when it comes to your family's finances.
What's fascinating here, I think, is how rules designed to close tax loopholes for the wealthy can sometimes create these complex challenges, even unintended negative impacts, for regular families just trying to save or invest for their kids' future, or maybe pass along some wealth.
Yeah.
It really highlights the interconnectedness of tax law, financial planning, and big life stages, like saving for college.
Okay, let's jump into the core of it then. What exactly is the Kiddie Tax, and what problem was it originally created to solve?
Okay, at its most fundamental level, the Kiddie Tax is a provision in the U.S. tax code. Its whole aim is to prevent a specific type of tax avoidance.
Okay.
Like we mentioned, it mandates that a certain portion of a child's unearned income gets taxed at the parent's marginal income tax rate, rather than the child's own, usually much lower, rate.
So that distinction, earned versus unearned income, that's absolutely critical here, isn't it?
It's the linchpin, absolutely.
So what defines unearned income in this context?
It's essentially any income that isn't earned from work. Pretty straightforward, actually.
So not wages, not salaries.
Correct. It does not include things like wages, salaries, tips, or income from self-employment where the child is actively providing services. That's considered earned income.
Got it.
And the Kiddie Tax does not apply to a child's earned income. They pay tax on that based on their own rates, their own standard deduction rules, just like, anyone else earning a wage.
Okay, so if my teenager earns, say, $5,000 from a summer job, the Kiddie Tax doesn't touch that $5,000.
Correct. That's earned. Safe from this rule.
Okay.
But If that same teenager has $5,000 in stock dividends or interest from investments,
Ah, that's the target.
that is unearned income, and that's exactly what the Kiddie Tax is concerned with.
Got it. So let's maybe list out some common examples. What does count as unearned income based on what the sources say?
Sure. The IRS instructions and other materials give a pretty comprehensive list. The most common culprits are taxable interest from savings accounts or bonds,
Okay.
ordinary dividends from stocks, and perhaps most significantly for many families, capital gains.
Right. Selling investments for a profit.
Exactly. Both capital gains realized from actually selling appreciated assets and capital gain distributions you might get from mutual funds or ETFs, even if the child doesn't sell anything themselves that year.
Ah, those fund distributions count too. Good point.
Yeah. Beyond investments, it also includes things like rental income, royalties, certain pension or annuity income, taxable scholarships or fellowship grants that aren't tied to services, so not reported on a W-2.
Okay.
Unemployment compensation, alimony received, the taxable portion of Social Security or pension benefits. Income from trusts can also be included.
Trusts too. Okay.
Yeah, though there's a specific exception for qualified disability trusts. Distributions from those are treated as earned income for one part of the Kiddie Tax calculation, which is interesting.
And does it matter how the child got the asset that's generating this income? Like if grandma gifted the stock versus mom and dad?
Nope, doesn't matter at all. The sources are very clear on this. Income produced by property owned by the child is considered unearned income for the Kiddie Tax, regardless of who gifted it or when.
Okay.
This is why assets held in those custodial accounts like UGMA or UTMA accounts, the Uniform Gifts to Minors Act or Uniform Transfers to Minors Act accounts,
Right, those common ones.
are frequently involved in triggering the Kiddie Tax. The income generated within those accounts legally belongs to the child.
And inherited IRAs came up too, right? Distributions from those count as unearned.
Yes, that's a really important one to remember. Distributions from inherited IRAs are considered unearned income. And if the child beneficiary meets the age and other criteria, those distributions can absolutely be subject to the Kiddie Tax.
Okay. Are there any types of passive income that don't fall under this definition? Anything that gets a pass?
Yes, thankfully, non-taxable income is excluded.
Like
The most common example is tax-exempt interest from municipal bonds.
muni bonds? Okay.
Also, the non-taxable portion of Social Security benefits wouldn't be included either.
Okay, so unearned income is pretty broad, covers most passive investment returns. Now, let's talk history. Why did Congress feel this was necessary way back in 1986? What was the loophole they were trying to shut down?
Right. So before the Tax Reform Act of 1986, there was this fairly common strategy, especially among higher income families, to reduce their overall tax burden.
Okay, what were they doing?
Parents who are in high tax brackets would effectively transfer income-producing assets, think stocks, bonds, to their young children.
Okay.
The child, having little or no other income, would be in a much, much lower tax bracket, maybe even the 0% bracket for certain types of income like long-term capital gains.
Ah, I see where this is going.
Yeah. So the investment income generated by these assets would be taxed at the child's super low rate rather than the parent's high rate. Result: significant tax savings for the family as a whole.
So it was a perfectly legal way to kind of game the system, using the child's low tax bracket as a shelter.
Exactly. It was seen as a loophole. The Kiddie Tax was specifically designed to eliminate that benefit. The core idea was to tax that type of income, above a certain small amount, as if it had stayed in the parent's hands, basically neutralizing the tax advantage of the transfer.
But there was a weird blip recently where this changed, wasn't there? Under the Tax Cuts and Jobs Act, TCJA, back in 2017.
Yes, that's a fascinating little detour in the history here. The TCJA actually changed the calculation method for a couple of years.
How?
Instead of taxing the kid's unearned income at the parent's rate, it taxed it at the rates that apply to trusts and estates.
Okay, why'd they do that? Seems simpler.
Maybe that was the intent, simplification,
Sure.
but it created some significant unforeseen problems.
Like what kind of problems?
Well, the trust and estate tax rates are structured very differently. They ramp up really quickly, hitting high rates on relatively low amounts of income. So this change inadvertently hammered certain families who were receiving benefits considered unearned income. Things like survivor benefits paid to children of fallen military personnel, Gold Star families, or students who received large taxable scholarships.
Wow, so not the wealthy families trying to shelter investment income at all.
No, exactly. These families, who were definitely not the target of the original anti-loophole measure, suddenly faced much higher tax bills on this income. It was a mess.
That sounds like a classic example of unintended consequences from tax reform.
It absolutely was. And the impact was widely criticized, as you can imagine. Recognizing this, Congress acted relatively quickly, actually.
What did they do?
As part of the Secure Act, passed in late 2019, they retroactively repealed that TCJA change. They switched the kiddie tax calculation back to using the parent's tax rate, effective for tax years starting after 2019.
Retroactively.
Yeah. Taxpayers could also choose to apply this change retroactively for 2018 and 2019 if it resulted in less tax for them.
That's useful history. It shows the law isn't set in stone and can adapt, even if it takes a bit to fix mistakes. Okay, so now we understand what unearned income is and why the tax exists. Who exactly falls under these kiddie tax rules? It's not just any kid with unearned income, right?
Correct. There are specific age requirements and several other conditions that must all be met for the kiddie tax to actually apply. And the age is determined as of the end of the tax year, December 31st.
Okay, what are the main age groups?
The primary group, the simplest one, is children under age 18 at the end of the tax year.
Under 18, got it. But it goes older than that.
Yes, it can also apply to children who are age 18 at the end of the year. However, there's an important exception for this age group.
Which is?
If their earned income for the year, wages, self-employment, etc., is more than half of their total support costs for the year, the kiddie tax rules generally won't apply to them.
Okay, so an 18-year-old who's working quite a bit and paying their own way might be exempt. What about college students? They often have some investment income, but maybe not much earned income.
Right. The rules extend up to age 23 for full-time students. The kiddie tax can apply to a child who is age 19 and under age 24 at the end of the year, if they are a full-time student for at least 5 calendar months during that year. Unless, again, their earned income is more than half of their total support.
So that definitely captures a lot of traditional college students. They might have income from a custodial account, but maybe aren't working enough to cover, say, tuition, room, board, all that stuff.
Exactly.
How is support calculated here? What counts?
Support is basically the cost of providing necessities and basic living expenses. Think food, housing, clothing, medical care, education, cost tuition, books, fees, transportation, that kind of stuff.
And who provides the support matters?
No, the total support includes amounts provided by anyone, the child themselves, parents, relatives, friends. But there's a crucial nuance for full-time students.
Okay.
Amounts received as scholarships that are excludable from gross income. So, tax-free scholarships are not counted as support provided by the student for this specific test.
So getting a big scholarship doesn't automatically mean they meet the providing more than half their support test through their own means.
Correct. It has to be their earned income covering more than half their costs. The scholarship money doesn't count towards that specific calculation.
That's a really important distinction. And you mentioned a little quirk for kids whose birthday is January 1st.
Yeah, it's a small detail in the IRS instructions. If a child turns 18 or 24 on January 1st of the following year, they're generally considered to be under age 18 or under age 24, respectively, for the entire preceding tax year.
So for the whole year ending December 31st, they fall into that younger age category for the kiddie tax rules.
Exactly.
Okay, so age is the primary gatekeeper, but you said other conditions must all be met. What are those?
Right, it's not just age. All of these following conditions must also be true for the kiddie tax to apply. 1. The child's total gross income for the year must be more than the unearned income threshold amount we'll discuss in a bit. For 2024, that's $2,600. For 2025, it's $2,700.
Okay, so they need some significant income overall.
2. At least some of that gross income must actually be unearned income.
Makes sense.
3. The child must actually be required to file a tax return for the year based on the general filing requirement.
Got it.
4. At least one of the child's parents must be alive at the end of the tax year.
Okay.
And 5, the child cannot file a joint tax return for the year, which is pretty rare for kids in these age groups, but it's technically a condition.
So let me see if I got this. A child could have maybe $1,000 in dividends. That's unearned income. But if that's their only income, even if they're 10 years old and parents are alive, the kiddie tax wouldn't apply because their total gross income isn't above that $2,600 or $2,700 threshold.
Exactly right. They need to meet the age test and have sufficient total income and have unearned income as part of that and be required to file a return and have at least one living parent and not file jointly. It's a checklist.
And does it matter if the child is claimed as a dependent by the parent on the parent's tax return?
No, that's another common point of confusion. The sources explicitly state these rules apply whether or not the child can be claimed as a dependent. Being independent for tax purposes doesn't get them out of the kiddie tax if they meet all the other criteria.
Okay. So just to recap, the exceptions or ways out of the kiddie tax based on these conditions, it generally won't apply if the child's earned income is more than half their support for ages 18-23, if they file a joint return, if neither parent is alive, or if their gross income is simply too low to trigger the tax or require filing a return in the first place.
That summarizes the key exclusions well. It's definitely not a simple under 18 gets taxed at parents' rate rule. There are specific tests.
Okay, deep breath. We know what it is, who it can apply to. Now, for the part that sounds like it gets really complicated, how is the tax actually calculated? Let's talk about the numbers, those thresholds that trigger the parent's rate.
Right, this is where we get into the specific dollar amounts.
Yeah.
These amounts get adjusted pretty much every year for inflation. So for the 2024 tax year, the rules are the first $1,300 of the child's unearned income is essentially tax-free. It's covered by the child's standard deduction amount, specifically for unearned income.
Okay, $1,300 tax-free.
Then, the next $1,300 of the child's unearned income is taxed, but it's taxed at the child's own tax rate.
Ah, so still at their potentially very low rate.
Exactly. If it's long-term capital gains or qualified dividends, that rate could even be 0% if the child's total income keeps them in the lowest tax brackets. If it's ordinary income like interest or non-qualified dividends, it would be taxed at their ordinary rate, probably 10% or 12%.
Okay, so the first $2,600 total, $1,300 plus $1,300, gets favorable treatment in 2024.
Precisely. It's the unearned income above that combined $2,600 threshold that gets hit with the kiddie tax. That excess amount is taxed at the parent's marginal tax rate.
That's the trigger point, $2,600 in 2024. Anything over that jumps to the parent's rate.
That's it. And for the 2025 tax year, these thresholds nudge up slightly due to inflation. The first $1,350 of unearned income will be tax-free.
Okay, up $50.
The next $350 will be taxed at the child's rate.
Same increase.
So the combined threshold for 2025 is $2,700. Unearned income above $2,700 will be taxed at the parent's marginal rate.
Okay, so $2,600 for 2024, $2,700 for 2025. Those are the key numbers to remember for when the parent's rate kicks in on that extra unearned income.
Correct.
Now, how does the actual Form 8615, figure out the tax amount? We don't need to go line by line, thank goodness.
No, definitely not. But the basic concept is helpful.
Yeah.
The form works by first figuring out the child's total unearned income.
Yeah.
Then it subtracts those threshold amounts we just talked about, the tax-free part, and the part taxed at the child's rate.
Okay.
What's left over is called the net unearned income. This is the amount that's potentially subject to the parent's higher rate.
So that's the specific slice of income we're worried about jumping up into the parent's tax bracket.
Exactly. Form 8615 then essentially calculates what the tax would be on that specific slice of income using the parent's tax rates.
How does it know the parent's rates?
It needs information about the parent's taxable income. The form performs this kind of hypothetical calculation. It temporarily adds the child's net unearned income onto the parent's taxable income and potentially the net unearned income of other children subject to the kiddie tax too.
Whoa, okay.
Just to see where that added income would fall within the parent's tax brackets. That determines the marginal rate, the rate on the next dollar earned. That applies to the child's net unearned income.
Okay, that makes sense. So it's adding the child's income to the parents only for the purpose of figuring out the rate. It doesn't actually increase the parent's own tax bill. It just influences the rate applied to the child's income.
Precisely. That's a crucial clarification. It's all about determining the correct rate for the child's unearned income above that threshold. Separately, the form calculates the tax on the rest of the child's income, their earned income, plus that initial chunk of unearned income taxed at their own rate. That part uses the child's standard tax rates.
Okay, so it's like two separate tax calculations happening on one form, basically. How does it put them together for the child's final tax bill?
The child's final tax liability is the sum of those two parts. One, the tax on their net unearned income, calculated using that parent's marginal rate we just derived. And two, the tax on all their other income, earned income, plus the initial unearned income portion, calculated using the child's own rates.
Okay, add those two together.
But wait, there's one more step, a final comparison check. The IRS instructions mention this, whichever is greater rule.
What does that mean?
The final tax reported on the child's return will be the larger of two amounts. Either the sum of the two parts we just mentioned, tax at parent's rate on net unearned, plus tax at child's rate on other income, or The total tax on the child's entire taxable income calculated only using the child's own tax rates, as if the kiddie tax rules didn't exist at all.
Huh. That whichever is greater rule sounds like a safeguard, doesn't it? To make sure the kiddie tax calculation doesn't somehow accidentally result in less tax than the child would have paid anyway.
Exactly. It ensures that the unearned income above the threshold is effectively taxed at the parent's rate, or the child's rate if that happens to be higher, which is unlikely but possible in weird scenarios. Guaranteeing the rule achieves its purpose of taxing that income at a higher rate than the child's base rate.
This definitely sounds like it requires getting the parents' tax information. What if the parents aren't filing a joint return? Which parents' info do you use then? That seems complicated.
It can be. The rules are specific to cover different family situations. If parents are married but filing separately, you use the return of the parent with the greater taxable income.
Okay.
If the parents are divorced or separated, and the child's custodial parent is considered unmarried for tax purposes, you use the custodial parent's return.
Makes sense.
If that custodial parent has remarried and files a joint return with their new spouse, you use that joint return.
Even if the new spouse isn't the child's biological parent?
Yes. If the custodial parent remarried but files separately from the new spouse, it generally goes back to using the return of the person with the greater taxable income, which could actually be the step-parent in that case.
Wow.
There are also specific rules for parents who were never married, often defaulting to the parent with greater taxable income if they lived together, or using custodial parent rules if they didn't. It gets detailed.
That complexity really highlights the need for parental cooperation, or at least access to that information, to do this right. What if a child, or maybe their guardian or tax preparer, just can't get that info from the required parent?
The IRS actually has a process for that. If you can't get the necessary parental information after making a reasonable effort, you can write a formal letter to the IRS Service Center where the parent's return is filed. The letter needs to explain you're requesting the info to comply with the law, show proof you tried and failed to get it from the parent, provide proof of the child's age, and include evidence of the child's unearned income.
And the IRS will provide it.
The IRS can then provide the necessary figures from the parent's return needed to complete the child's Form 8615.
Good to know there's a backup plan. And I assume if the parent's tax situation changes after the child's return with Form 8615 is filed, maybe an audit, or they amend their return, that could ripple back to the child's tax.
Yes, absolutely, that's a possibility. If the parent's taxable income or tax liability changes, or if the net unearned income of other children subject to the kiddie tax changes.
Right, because that affects the hypothetical calculation.
Exactly. The child's tax liability might need to be refigured using the updated parental info. If this results in a different tax amount for the child, they might need to file an amended return, Form 1040X.
Okay. Are there any other taxes a child hit by the kiddie tax might also need to worry about? Like, does it trigger anything else?
The IRS instructions do mention that children subject to the kiddie tax could potentially also be subject to the alternative minimum tax, or AMT.
Oh, the AMT.
Or the net investment income tax, NIT. AMP is that parallel tax system. Could apply if the child has certain tax preference items or just high income overall. NIT is that extra 3.8% tax on investment income for higher earners.
Could a child really have income high enough for NIT?
It's possible, especially if they inherit significant assets or have large capital gains. Their modified adjusted gross income would need to exceed the threshold, currently $250,000 for single filers. So less common, but possible. These would involve extra forms. Form 6251 for AMT, Form 8960 for NIT.
Okay, good to be aware of those possibilities too. Let's try and make this more concrete now with some examples from the sources. The Greenbush source had a good one about gifting appreciated stock.
Yes, this is a perfect illustration, not just of the kiddie tax, but also the potential pitfalls beyond the tax.
Okay, lay it out for us.
Imagine parents bought shares of, say, Apple stock years ago. Their cost basis is low, maybe negligible, it's appreciated significantly. Let's say there's an unrealized long-term capital gain of $30,000 sitting there.
Nice problem to have, but okay.
Right. The parents are in a high tax bracket. If they sell it, they'd pay the 15% or maybe even the 20% long-term capital gains rate on that whole $30,000 gain.
So a decent tax hit for them.
Definitely. So they think, aha, let's gift the stock to our 16-year-old child who has zero income. The child can sell it and maybe pay 0% capital gains tax because the child's income is so low.
Seems like a clever plan on the surface, right? Using the child's lower bracket.
Exactly. And that is precisely the scenario the kiddie tax was designed to prevent.
Okay, so how does it play out with the kiddie tax rules? Let's use the 2025 numbers, the $2,700 threshold.
Okay. The child receives the gifted stock. They sell it, realizing that $30,000 long-term capital gain. Now, the Kiddie Tax rules kick in. The first $30,350 of that gain is tax-free, covered by the standard deduction.
Right.
The next $150 is taxed at the child's rate. Since they have no other income, their long-term capital gains rate on this portion is 0%.
So the first $2,700 of the gain is taxed at 0%. Still sounds pretty good.
It does for that first bit. But the rest of the gain,
The amount over $2,700.
which is $30,000 minus $2,700 or $27,300, that amount is subject to the Kiddie Tax. It gets taxed at the parent's marginal rate for long-term capital gains.
So if the parent's rate is 15%,
That $27,300 gain is taxed at 15%.
ouch. So instead of the whole $30,000 being potentially tax-free at the child's 0% rate, $27,300 of it gets taxed at the parent's 15% rate.
No.
It's what, over $4,000 in tax? $27,300.15 equals $4,095.
Exactly. A tax bill of over $4,000 that the family was explicitly trying to avoid with the gift.
The Kiddie Tax clawed it back.
It did. And the Greenbush source also points out, if this were ordinary income like interest or short-term gains, the difference could be even more dramatic. If the child's rate is 0% or 10% and the parent is in the highest ordinary income bracket, 37%.
That $27,300 would be taxed at 37% instead of 10%. Huge difference.
Huge. Almost $10,000 in tax on that $27,300 instead of maybe $2,700.
Okay, that example makes the impact very clear. What about the Amanda Black example from the IRS source? She was 13, had different kinds of income.
Right. Amanda Black, she's 13. She has dividends of $1,300, wages of $2,100, taxable interest of $1,400, tax-exempt interest of $100, capital gains of $300, and capital losses of $200.
Okay, a mix of stuff. How do we figure out her unearned income for Kiddie Tax purposes from that list?
Okay, let's go through it following the IRS logic. Her wages, $2,100, are earned income, not part of the Kiddie Tax calculation itself, though it affects her overall tax.
Right.
Her tax-exempt interest, $100, is non-taxable, also ignored for this purpose.
Got it.
Her capital gains, $300, and capital losses, $200 net out. She has a net capital gain of $100, $300, $200. Capital gains are unearned income.
Okay, $100 unearned there.
Her taxable interest, $1,400, is unearned income.
$1,400 more.
And her dividends, $1,300, are unearned income.
$1,300 more.
So her total unearned income for Kiddie Tax purposes is the sum of those three. $1,300 dividends plus $1,400 interest plus $100 net capital gain. That adds up to $2,800.
$2,800 in unearned income. Okay. For 2024, the threshold where the parent's rate kicks in is $2,600. Since she's 13, under 18, and her unearned income, $2,800, is over that threshold, $2,600, she is subject to the Kiddie Tax.
That's exactly right. We should also check the other conditions quickly. Her total gross income is $2,100 wages plus $1,300 dividends plus $1,400 interest plus $100 net gain. It's $4,900. Yeah. That's high enough to require her to file a return. She's under 18, has unearned income over the threshold, presumably has a parent alive, and isn't filing jointly. All conditions met.
Okay. And how would the tax actually be calculated on her $2,800 of unearned income using 2024 thresholds?
Using the 2024 numbers, $1,300 free, $1,300 at child rate, $2,600 total threshold. The first $1,300 of her $2,800 unearned income is tax-free. The next $1,300 is taxed at her rate. The amount above $2,600 is her net unearned income subject to the parent's rate. That's $2,800 minus $2,600, which equals $200.
Ah, so only $200 of her unearned income actually gets taxed at her parent's marginal rate in this case.
Correct.
Even though it's a small amount in this specific example, it perfectly illustrates how just exceeding that threshold, even by a little bit, triggers the whole mechanism and applies the parent's rate to that excess amount.
Exactly. And while $200 taxed at, say, the parent's 24% rate instead of the child's 10% rate might not be a huge dollar difference here, this same framework applies if the unearned income was $30,000 over the threshold, like in the Apple stock example. That's when the tax difference becomes really significant.
Right. So given this complexity and the potential tax hit, the obvious question pops up. Can you just, avoid the Kiddie Tax? Is there a way around it?
Well, you can't avoid the tax rule itself if you meet all the conditions and have income over the thresholds. It's the law. It applies. However, you can absolutely plan your financial activities to minimize its impact or even completely sidestep its application in a given year.
Okay. How would someone do that? What are the strategies?
The most direct way, the simplest way to avoid the Kiddie Tax applying is to ensure the child's total unearned income stays below that second threshold amount.
So below $2,600 for 2024 or below $2,700 for 2025.
Exactly. If their total unearned income for the year is, say, $2,500, then none of it will be taxed at the parent's rate, even if they're 10 years old and meet all the other conditions. The Kiddie Tax calculation simply won't result in any tax at the parent's rate.
So managing the amount and maybe the type of income-producing assets held directly in the child's name is really key here.
It is, which leads to the next strategy. Using specific types of accounts or investments that help with this.
Like what?
Absolutely. This is where strategic use of tax-advantaged accounts becomes really powerful. The sources consistently highlight 529 plans as a prime example.
Right, the college savings plans.
Exactly. These plans are specifically designed for saving for future education expenses. The earnings inside a 529 plan grow tax-deferred year after year. And critically, as long as the withdrawals are used for qualified education expenses, tuition, fees, room, board, books, etc., those distributions are entirely tax-free at the federal level, and often at the state level, too.
So the key point for Kiddie Tax, the annual earnings building up inside the 529 plan, they aren't considered unearned income subject to the Kiddie Tax each year.
Correct. The sources confirm that. The earnings accumulation inside of 529, including those held in custodial 529 accounts owned by the child, are not subject to the Kiddie Tax rules annually.
Wow. That makes them a really powerful tool for holding investments meant for a child's college without worrying about triggering this tax every year based on the parent's rate.
It's a huge advantage, a primary way to shield investment growth for education from this rule.
What about retirement savings for a child? That might sound a bit premature, but if a kid has earned income, they can contribute to an IRA, right?
Yes, this is another excellent strategy the sources mention.
Yeah.
If a child has earned income from that summer job, babysitting, mowing lawns, whatever, they can contribute up to the amount of their earned income for the year or the annual IRA contribution limit, $7,000 in 2024, whichever is less, to an IRA.
And a Roth IRA is often recommended.
Often, yes, because with a Roth IRA, contributions are made with after-tax dollars. But the key is that the earnings grow completely tax-free, and qualified withdrawals in retirement are also tax-free.
And since the growth and qualified distributions are tax-advantaged, the Kiddie Tax doesn't apply to those annual earnings inside the Roth IRA either.
Exactly. The contributions themselves come from earned income, which isn't subject to the Kiddie Tax anyway, and the subsequent growth and qualified distributions from the Roth are tax-exempt. So no Kiddie Tax issues there.
That's fantastic. It allows for potentially decades of tax-free growth for a child, completely outside the Kiddie Tax rules, just by leveraging their earned income.
It's a really effective long-term wealth-building strategy that sidesteps this whole issue.
Okay, so using these dedicated tax-advantaged accounts, 529s for education, Roth IRAs funded by earned income for retirement, that seems like the cleanest way to shield asset growth from the Kiddie Tax. What if you do hold assets in a regular taxable account in the child's name, like a standard UGMA or UTMA? Any strategies there?
Yes, if you are holding assets in a standard custodial account or directly in the child's name, you could try to be strategic about the types of investments you choose.
How so?
You could lean towards investments that generate minimal current taxable income each year. Things like growth stocks that don't pay dividends, where the return primarily comes from appreciation.
Okay.
Or holding investments for long-term appreciation rather than engaging in frequent trading that generates short-term gains. Long-term capital gains can have lower rates, but remember, they are still unearned income subject to the Kiddie Tax above the threshold.
Right.
Tax-exempt municipal bonds are another option. As we mentioned, their interest isn't counted as unearned income for this rule. Though you do need to keep an eye on potential alternative minimum tax implications with muni bonds if income gets high.
So the idea is to focus on investments where the taxable event, the income recognition, is delayed until the asset is actually sold, rather than having interest or dividends drip out and potentially trigger the tax year after year.
That's the concept, minimizing the annual unearned income flow.
These are all helpful tactics for managing the Kiddie Tax itself. But the Greenbush source especially made a really strong point that the Kiddie Tax, while maybe annoying, is often the least of your worries when you put assets directly in a child's name.
Yes. This feels like a really crucial section for anyone listening who is considering gifting assets to their kids or grandkids.
I agree. It seems like the implications go way beyond just this one tax rule.
Absolutely. While the kiddie tax gets the headlines, sometimes placing assets directly in a child's name, especially through those standard custodial accounts, UTMA, can have much broader and potentially much more detrimental financial consequences that families often completely overlook.
And what's the biggest one? The sources seem to hammer this point home.
By far, the most significant impact mentioned in multiple sources is the effect on eligibility for college financial aid.
Yes, the FSO form, the free application for federal student aid. How does asset ownership mess with that?
This is a major pitfall. Financial aid formulas, including the main federal one, ASSA, weigh assets owned by the student much more heavily than assets owned by the parent.
How big is that difference in weighting?
It's substantial. Under the current AFSA methodology, assets owned by the child like money in that UTMA account are assessed at a rate of 20% of their value each year towards the calculation of what the family is expected to contribute to college costs, the Student Aid Index, or SAI.
20%. Okay, what about parent assets?
Parent assets, in contrast, are assessed at a much lower rate, only up to 5.64%.
Wait, 20% versus a max of 5.64%. That's almost 4 times the impact.
Exactly. Let's use that Apple stock example again from Greenbush. Say the family gifts the $30,000 worth of stock, or maybe the cash proceeds after selling it, to the child, and it's sitting in a custodial account when the child applies for college aid.
Okay.
That $30,000 could reduce their aid eligibility by about $6,000 per year. 30,000 times 20%.
Wow.
Now, if that same $30,000 were held in the parent's name instead, it would only reduce aid eligibility by about $1,692 per year, $30,000 times 5.64%.
That's a difference of over $4,300 in lost financial aid each year of college, just because of whose name is on the account.
Precisely. Over 4 years of college, that could easily be over $17,000 in lost financial aid eligibility.
That is a massive consequence. That completely dwarfs the potential kiddie tax liability we calculated earlier on the gain itself.
Often, yes. The financial aid impact can be far larger than the tax impact. And it gets worse when you look at income.
How is income treated for FSI?
Child income is assessed even more harshly at a rate of 50% against aid eligibility.
50%, half of their income is expected to go towards college.
Essentially, yes, above a small income protection allowance. Compare that to parent income, which is assessed at a maximum rate of 47%, but often effectively lower due to larger income protection allowances based on household size.
So going back to the stock example again. If the child sells that gifted stock and realizes the $30,000 capital gain, even if the kiddie tax applies and taxes some of it at the parent's rate, that full $30,000 gain is still considered the child's income for FAFSA purposes in the year it shows up on their tax return.
Yes, it's their income.
And FSA uses income from 2 years prior, doesn't it? The prior year income?
That's the rule, the 2-year look back for income. So think about the timing. If a child realizes a large capital gain from selling gifted stock in, say, their junior year of high school, that income shows up on the FSA they file in the fall of their senior year of high school, which uses income data from 2 years prior. That $30,000 gain showing up as student income could potentially reduce their financial aid eligibility by roughly $15,000. 50% of $30K in that critical first year of college funding applications.
That is absolutely staggering. A well-meaning gift or an investment strategy designed to maybe save a little on taxes could end up costing the family tens of thousands of dollars in college aid they otherwise would have received.
It truly can be. It's one of the most impactful and often surprising lessons from the sources. The desire to give a child a financial head start can unintentionally severely penalize them when it comes time to actually pay for college. It's a potential college funding disaster hiding in plain sight.
Okay. Wow, that's a huge one. What's another major pitfall the sources mentioned beyond the financial aid catastrophe? They talked about cost basis rules and something called step up in basis.
Yes, this is another critical consideration, especially if you're thinking about passing down appreciated assets like stocks, real estate, mutual funds to the next generation. It relates to how capital gains are calculated.
Okay, how does it work with gifting?
When you gift an asset during your lifetime, the recipient, your child, in this case, generally takes on your original cost basis in that asset. This is known as a carryover basis.
Okay, so if I bought stock for $10 years ago and it's now worth $100 and I gift it to my child, their cost basis is still that original $10.
Exactly. If your child then turns around and sells that stock for $100, they will realize a $90 capital gain. $100 selling price minus their $10 carryover basis.
And that $90 gain is taxable to them, potentially subject to the kiddie tax we discussed earlier, depending on their age and other income.
Correct. They inherit your low basis and thus your built-in capital gain.
What's the alternative, and why is it often better from a tax perspective?
The alternative is what happens when assets are inherited after your death. In that scenario, the beneficiary, the person inheriting the asset, typically receives what's called a step-up in basis.
Step up. What does that mean?
It means the cost basis of the inherited asset is adjusted or stepped up to its fair market value on the date of the original owner's death.
Whoa, so in that same example, I bought stock for $10. It's worth $100 when I pass away. My child inherits it. Their new cost basis becomes $100, not my original $10.
Precisely. Their basis gets stepped up to the $100 value at the time of death.
So if they then sell that stock for $100 shortly after inheriting it,
their taxable gain is calculated as the selling price, $100, minus their stepped-up basis, $100, which equals $0 gain.
Zero gain. So no capital gains tax is due on all that appreciation that happened while I owned it?
Correct. The step-up in basis effectively erases the capital gains tax liability on all the appreciation that occurred during the original owner's lifetime.
Wow. Okay, so let's contrast $90 taxable gain if gifted versus potentially $0 taxable gain if inherited. That could mean paying capital gains tax maybe 15%, 20% on that entire $90 appreciation versus paying absolutely nothing.
It's a huge tax difference. The Greenbush source used a house example, which makes it even clearer. Imagine a parent bought a house for $200 K basis, and it's worth $400 Ks now.
Okay. $200 K appreciation.
If they gift the house to their child, the child gets the $200 K carryover basis. If the child later sells it for $400 K, they have a $200 K taxable gain. At a 15% capital gains rate, that's potentially $30,000 in taxes. But if the parent holds the house until death, and the child inherits it when it's worth $400 K, the child gets a stepped-up basis of $400. If they sell it immediately for $400, their taxable gain is zero. That potential $30,000 tax bill disappears.
That completely reframes the decision to gift versus hold and let the child inherit, especially for highly appreciated assets. People sometimes gift assets like a house or stock just to avoid probate, right? Thinking it's simpler.
Exactly. They think they're simplifying things by avoiding probate, but losing that step up in basis often results in a far, far greater tax bill for the child down the road than the cost or hassle of probate ever would have been.
It's a classic example of letting the tax tail wag the planning dog.
It really is. Sacrificing a huge tax benefit for a relatively minor convenience. It's a critical point many families miss.
Absolutely critical. Okay, what other non-tax pitfalls did the sources mention about putting assets in a kid's name?
Control, or rather loss of control. That's a major one.
How so?
When you gift assets directly to a child or into one of those standard custodial UGMA, UTMA accounts, those assets legally belong to the child, period.
Okay.
Once the child reaches the age of majority in their state, typically 18 or 21, they gain full, unrestricted legal control over those assets.
Unrestricted, meaning they can do literally whatever they want with that money. Buy a fancy sports car instead of using it for college tuition.
Exactly. The parents lose all legal control. They lose the ability to dictate how that money is used once the child hits that magic age. The money might have been intended for college or starting a business or a down payment on a first home.
Yeah.
But the child is legally free to spend it however they choose. This can create significant family tension and completely derail the parents' original financial planning intentions for that money.
That's a really big leap of faith, putting potentially significant assets under the complete control of an 18 or 21-year-old.
It is. It requires a lot of trust and maturity on the child's part, which isn't always predictable.
What about legal exposure? Does putting assets in the child's name create risks there?
The sources also point that out, yes. Assets held directly in a child's name could become vulnerable in future legal situations the child might encounter.
Like what?
If the child gets sued, maybe a car accident or some other liability, those assets held in their name could be fair game for creditors pursuing a judgment.
Oof.
And another big one, if the child goes through a divorce later in life, assets held solely in their name could potentially be considered marital property, depending on how they were handled during the marriage and specific state laws. An ex-spouse might be entitled to a portion.
So a gift you intended purely to help your child could end up being claimed by their future ex-spouse or lost in a lawsuit. That's another layer of risk most people probably don't even think about.
It adds a layer of potential exposure that just isn't present if the assets are held differently, perhaps in a more protected structure like certain types of trusts.
You also mentioned Medicaid and long-term care planning earlier. How does gifting interact with that whole complex area?
Right. For individuals who might need long-term care down the road, nursing home care, for example, and might need to rely on Medicaid to help cover those very high costs, gifting assets can complicate eligibility.
Wow.
Medicaid has strict asset limits for eligibility. And crucially, it has a look-back period, 5 years in many states, like New York mentioned in one source. Any gifts made within that 5-year period before applying for Medicaid are reviewed.
And they count against you.
The value of those gifts made during the look-back period could still be counted against the applicant's eligibility. It might impose a penalty period where they're ineligible for benefits, essentially requiring them to privately pay for care for a time equivalent to the value of the gifts made.
So someone might gift assets years in advance, trying to get below the Medicaid asset limits, but that strategy directly conflicts with the step-up in basis advantage we just talked about.
Precisely. It's another conflict. Gifting might, if done early enough, help satisfy the Medicaid look-back rules and also avoid probate. But you lose the step-up in basis for the beneficiary, potentially creating a big tax bill later.
Whereas inheriting gets the step-up, which saves taxes, but keeps the assets in the potential Medicaid applicant's name longer, which might mess up their eligibility if they need care suddenly.
Exactly. Another complex trade-off where the method of transferring assets has these cascading, often conflicting effects.
And we circled back to inherited IRAs already, just noting that distributions are unearned income potentially subject to Kiddie Tax.
Yes, and the sources also briefly mentioned that the relatively new rules requiring most non-spouse beneficiaries to drain inherited IRAs within 10 years have added even more complexity to managing those assets, especially for younger beneficiaries who might face Kiddie Tax on those required distributions.
Okay. Given this whole minefield of potential pitfalls, the Kiddie Tax itself, the huge college aid impact, losing the step-up in basis, losing control, legal exposure, Medicaid issues, what are the alternatives? If outright gifting or using simple UGMA, UTMA accounts is so problematic, what else can people do?
The sources briefly touch on exploring alternatives, things like establishing trusts.
Okay, trust.
Or utilizing transfer on death, TOD, or pay on death, POD, registrations for certain financial accounts, like brokerage accounts or bank accounts.
How do trusts help?
Trusts can be incredibly flexible. They can be structured in many different ways to provide much more control over how and when assets are distributed to beneficiaries, potentially protecting assets from creditors or divorce, and depending on the type of trust, like a revocable living trust, still allowing the beneficiaries to receive that valuable step-up in basis upon your death, unlike a direct lifetime gift.
So trusts offer more control and potentially preserve the tax benefits.
They can, yes, though they also involve setup costs and administrative complexities. TOD/POD registrations are simpler. They help assets bypass probate, but they generally don't change the basis rules the step-up still size because the transfer happens at death.
This entire discussion really drives home the point that giving assets to children, especially income-producing ones, is far more complex than just, writing a check or transferring some shares online.
It is a decision with significant, deeply interconnected tax, financial aid, legal, and control implications. It really requires careful consideration within the context of your family's entire financial picture, your goals, your timelines. What seems like a simple, generous gift can trigger this domino effect of consequences, some good, some potentially very bad.
So let's wrap up by talking about the filing process itself. If the Kiddie Tax does apply, who is actually responsible for filing the tax return? Is it the child or the parent?
Typically, if the child meets all the conditions for the Kiddie Tax, they are required to file their own tax return.
The child files their own 1040.
Yes. And they must attach Form 86 Wimpy tax for certain children who have unearned income to that return. Form 8659 is the specific form where the Kiddie Tax calculation is actually performed.
Okay, so child files, attaches Form 8659. Is there ever an option for the parents to just report the child's income on their own tax return instead, to simplify things?
Yes, there is an option, but it's an election, and it has some pretty strict limitations. Parents may be able to elect to report certain types of their child's unearned income directly on their own tax return.
Which types?
Specifically, only interest income, ordinary dividends, and capital gain distributions, like from mutual funds. not capital gains from selling stock, not rental income, etc.
Okay, limited income types. And how do they make this election?
They use Form 8814, parents' election to report child's interest and dividends, which gets attached to the parent's 1040 return. If they qualify for and make this election, the child generally doesn't have to file their own separate tax return.
That sounds simpler. What are the catches, the downsides of using Form 8814?
The sources point out a few key ones. First, as we said, it only applies to those specific types of unearned income. If the child has other types, like gains from selling stock or income from a trust, you can't use Form 8814. Second, and this is really important, electing to report the income on the parent's return using Form 8814 may actually result in a higher overall tax liability on that income compared to filing Form 8615 with the child's return.
Why would it be higher?
Because the income thresholds and the tax rate calculations work slightly differently on Form 8814. Plus, the child doesn't get to use any of their own standard deduction amount against the income reported on the parent's Form 8814. That first $1,300 or $1,350 tax-free threshold essentially disappears under this election.
So while it simplifies the filing process by avoiding a separate return for the child, it might not be the most tax-efficient method. Could cost more in taxes.
Exactly. It's a trade-off between convenience and potentially paying more tax.
So filing Form 8615 attached to the child's own return seems like the more common and often more financially advantageous approach if the kiddie tax applies.
That's generally the standard route, yes, unless the parent specifically qualifies for Form 8814, understands its limitations, and consciously chooses that path, maybe for very small amounts of income where the tax difference is negligible.
Okay, wow. We have really done a deep dive here today. We've covered what the kiddie tax is, why it was created basically to stop parents from using kids' low brackets to shelter investment income.
Right, the anti-avoidance purpose.
We talked about who it applies to, those age rules under 18 or 1823 if students not supporting themselves, and the other conditions like income thresholds and having a living parent. We dug into how the calculation works using those key thresholds, $2,600 for 2024, $2,700 for 2025, above which the parent's marginal rate kicks in on the child's net unearned income.
And the mechanics of Form 8615, using the parent's info just to find the rate.
Exactly. And the filing options, Form 8615 on the child's return versus the more limited Form 8814 election on the parent's return.
And I think crucially, we spent a good amount of time unpacking those potentially much larger non-tax consequences of putting income-producing assets directly in a child's name.
Yeah, that felt really important.
The dramatic negative impact on college financial aid eligibility.
20% versus 5.6% assessment.
Right. The loss of that incredibly valuable step-up in basis rule for appreciated assets compared to inheriting them.
Which could mean thousands in extra capital gains taxes.
The loss of parental control once the child reaches 18 or 21.
The sports car versus tuition issue.
And the potential exposure of those assets to the child's future creditors or even divorce proceedings.
The key lesson, really, that seems woven through this whole discussion is that while the intention behind giving financial gifts or investing for children is almost always good, the mechanism you use to hold those assets matters immensely.
It really does.
Placing income-producing assets directly in a child's name or in those simple custodial accounts triggers this whole cascade of rules and potential pitfalls that can actually work against your family's bigger financial goals, especially around funding college or planning future wealth transfer efficiently.
Careful. Informed planning is just absolutely essential before making significant gifts of income-producing assets to children or setting up accounts in their names. Understanding these rules and all the ripple effects allows you to explore alternatives like 529s, trusts, maybe just holding assets longer yourself that might better align with your family's long-term objectives and help you avoid these really painful, unintended negative consequences.
It certainly does. So, considering the complexity of the tax calculation itself involving the parent's income, the relatively low income thresholds that can trigger it, and especially those potentially far more significant and long-lasting impacts on things like college aid or how future generations inherit assets. Maybe the biggest takeaway here isn't just how the kiddie tax works.
What is it then?
Maybe it's asking the fundamental question. Is putting significant income-producing assets directly in a child's name actually the right move for your family's overall financial blueprint in the first place?
That's a great point. It really prompts the question. When does trying to give a child a financial head start inadvertently end up creating a whole new set of financial hurdles for them and for you further down the line?
Definitely something worth mulling over. If you, listening, have a child with existing unearned income that's getting close to or exceeding those thresholds, $2,600 in 2024, $2,700 in 2025, or if you're thinking about making significant financial gifts of income-producing assets.
Yeah.
Taking a much closer look at your specific situation, understanding all these interconnected pieces, and perhaps consulting with a qualified tax advisor or financial planner seems highly recommended. Navigating these waters really requires understanding all the currents.
Agreed. Informed decisions are always the best defense against unintended consequences, especially in tax and financial planning.
And that wraps up our deep dive into the U.S. Kiddie Tax and the much broader, often surprising implications of gifting assets to children.